Welcome back to WAS Capital. This is the short explainer video for weekly report number 24, covering May 18th to May 24th, 2026. The full article is available to read or listen to on Substack, and I'll leave the link in the description below. The theme this week's a familiar one. Surface level calm, contradicted by structural tension underneath. Equities recovered, oil fell, and volatility compressed. On the face of it, a constructive week, but the bond market's having a different conversation entirely. And that conversation's what this report's mostly about. Here's what we're covering. The mechanical signals the bond market's sending about the Fed's current position, how oil and geopolitics are fitting into the distributional picture, and what the crypto divergence this week is telling us about risk appetite beneath the headline numbers. US equities had a strong week. The Dow added 2.13%, the S&P 0.88%, and the Russell 2000 led the complex up 2.55%. Small cap outperformance is worth pausing on. The Russell's more sensitive to short-end rate expectations than large cap indices. When it leads, the market's typically pricing modest near-term rate relief at the short end of the curve. That's the surface read. The structural read's different. At the same time small caps were rallying, the 30-year Treasury hit 5.197%, its highest print since July 2007. The equity market's focused on the near-term rate path. The long end's focused on something else entirely. Both can be correct simultaneously. They can't both remain correct indefinitely. Behind the curve is one of those phrases that loses its meaning through overuse, so let's ground it mechanically so we're on the same page. The Fed funds rate is currently 3.50 to 3.75%. The 2-year Treasury closed at 4.123%. That's a 37 basis point premium over the top of the policy rate. The 2 year's a near-term rate expectation instrument. When it trades above the current Fed funds rate, the market's telling policymakers, the current rate's too low for observed conditions. That's not a forecast. It's a mechanical signal from the most liquid short-duration instrument in the world. 3 instruments are simultaneously converging on that signal. The 2-year above the Fed funds rate, PCE at 3.5% against a policy rate that, in real terms, is approximately negative, and the 30-year at 5.197%, telling you long-term inflation expectations aren't anchored at 2%. Running an expansionary monetary policy stance, while PCE sits 175 basis points above target, is the textbook definition of behind the curve. The 30-year yield doesn't just reflect expected short rates. It contains a term premium, the extra compensation investors demand for the risk of holding long-duration paper, uncertainty about future inflation, uncertainty about the future policy path, the cost of committing capital for decades rather than months. When the term premium's elevated, investors are pricing genuine uncertainty. In this case, that uncertainty has a specific shape, no established track record for the incoming chair at the FOMC table, and a political environment where the preference for cuts has been stated explicitly. The bond market doesn't yet know how WASH behaves when the data and the political pressure pull in opposite directions. Until it does, the long end prices that uncertainty in. The CME FedWatch tool reflects the shift. Approximately 70% probability of at least one hike by December 2026. That's a substantial repricing from the cut-heavy consensus of early 2025. The markets absorbed the inflation data and concluded the base case is now hold to hike, not cut. Most attention goes to CPI and PCE when it comes to inflation. PPI gets less coverage, but it's arguably the more important forward-looking signal. PPI measures the prices producers receive for goods and services. It includes raw materials, intermediate goods, and wholesale costs, for example. These pressures work through the supply chain before they reach consumer prices. The transmission lag's typically 2 to 3 months. PPI isn't a lagging confirmation of where inflation's been. It's a read of the road ahead of us. Last week, PPI came in at plus 1.4% against a 0.5% consensus estimate. That's not a rounding error. It tells you the pipeline feeding consumer inflation remains pressurised and hasn't yet fully surfaced in the PCE data the Fed's currently watching. PCE at 3.5% is the rearview mirror. PPI at 1.4% is the road ahead. Cutting into that signal would be adding stimulus while the pressure's still building upstream. The data doesn't support it. Oil fell sharply across all benchmarks this week. Brent down 5.08% to $100.48, West Texas down 4.83%. But the number that matters is the OMOIL premium over Brent. Last week that premium was 88 cents. This week it compressed to 4 cents. When the physical market falls faster than the paper market, it's a constructive signal. The physical market's doing its own probability discounting on Iran deal likelihood, independent of the political rhetoric. The context makes this remarkable. New preconditions from the administration, the IRGC threatening a global offensive, a French vessel attacked in the Strait of Hormuz, the UAE under Iranian drone and missile fire. Those headlines in isolation are bearish for supply. The oil market fell anyway. I file this in the reasons unknown category, but I heed the signal all the same. The gap between the political rhetoric and the price actions where the honest probability estimate lives. Bitcoin fell 3.49% on the week. The more concerning point isn't the quantum of the move, it's the context. Broad equities were green across every major index. Risk appetite, by most conventional measures, improved materially. Bitcoin diverged in the negative direction regardless. Liquidity conditional assets are supposed to move with risk appetite when liquidity conditions are intact. When they diverge while the rest of the complex is bid, it demands attention. It suggests something in the asset's own order flows under distribution pressure. A predefined technical trigger was reached on Thursday's close inside Valkyrie. Per the rules of the system, the signal leads and the position follows. The Bitcoin allocation was reduced 50% as a result, from 10% overall to 5%. Cash rose from 15% to 20%. The position's under active monitoring. The full exit signal threshold is now closer than it was. The overall distribution skew remains negative, but cautiously less bearish than last week. The bear case falls to 32%. The base case rises to 47%. The bull case edges to 21%. The left tail contracts modestly as oil falls, and the VIX posts its largest single-week compression of the conflict period. That improvement's real. But it's not a regime shift. The ceasefire remains fragile. The bond market's pricing the Fed as behind the curve. Bitcoin's exhibiting distributional behavior, inconsistent with a clean, risk-on environment. The skew's still negative. Distribution alpha approximately minus 0.65 versus minus 0.80 last week. All of this converges on June the 16th. Warsh walks into his first FOMC with a data set that doesn't support cuts, a market pricing hikes, and political pressure pulling in the opposite direction. How he navigates that triangle will tell us a great deal about what the second half of 2026 looks like. The full report's linked in the description below. Read or listen on the Substack app. Until next week, stay safe out there. WOS.